Okay, so you want to get into like the nitty-gritty of what's going on with the government's budget and the economy, but without like poring over, hundreds of pages of reports and data.
Right.
So basically you want the inside scoop, right?
Exactly.
That's what we're doing here today. We're taking a deep dive into the government's,
fiscal situation.
Yeah. Fiscal ratios, budget assumptions, all based on the material, that pasted text we've been looking at.
Yep.
We're going to, extract the most important insights for you so you can really understand like the big picture without getting lost in the, weeds.
Absolutely. The government has given us a lot to work with here.
Yeah.
I mean, we've got projections on everything from economic growth to spending priorities.
Yeah.
We'll be looking at the main drivers, the trends in the deficit, how revenues and expenditures are lining up, the financing mechanisms, and even the focus on specific sectors. So think of this as your guide to understanding the government's financial plan for the coming year.
Okay, so let's unpack this thing.
Okay.
Let's start with the core budget assumptions.
Okay.
The material says they're anticipating a little bit of an uptick in economic growth.
Right.
With nominal GDP expected to rise from 9.7% in fiscal year 25 to 10.1% in fiscal year 26.
Okay.
What's your initial take on that projection?
Well, the first thing that jumps out at me is that expectation of slightly faster growth.
Okay.
And it's really important because remember, this GDP growth figure is kind of the foundation for so many other projections, especially when it comes to tax revenue.
Right.
If the actual growth falls short, that's going to have ripple effects throughout the budget.
Okay, so speaking of tax revenue, the government seems to be projecting a pretty stable tax revenue to GDP ratio around 12%.
Yeah.
But it's interesting when you look at the breakdown within that, direct taxes are expected to make up a bigger chunk, while indirect taxes are going to kind of stay at the same level.
Exactly.
So what's going on there?
So with direct taxes, that projected increase in the ratio to GDP going from 6.9% to 7.1%, suggests that the government is expecting to see more income and corporate taxes coming in relative to the size of the economy.
Got it.
The stable indirect tax ratio at about 4.9% means that we're looking at a pretty steady contribution from sources like the GST and excise duties.
Okay.
This shift towards direct taxes could be due to a number of things, maybe a growing formal sector or even the impact of recent tax policy changes.
So this is where it gets really interesting.
Okay.
Even though we've got this projected economic growth and a steady overall tax take relative to GDP, the budget size as a percentage of GDP is actually shrinking.
Right.
It's going from 14.6% down to 14.2%.
Yeah.
That seems a little bit counterintuitive, doesn't it?
It does seem a bit surprising at first glance.
Yeah.
But it's actually a key takeaway. While the absolute amount of money in the budget is going up, the fact that it's becoming a smaller portion of the overall economy suggests a deliberate move towards fiscal consolidation.
Okay.
In other words, they're trying to get their financial house in order.
Right.
It could also mean they're strategically choosing to prioritize certain types of spending over others.
Okay.
Now, while this does show some fiscal discipline, it also might mean that the government is going to be relying more on the private sector for growth and investment in certain areas.
Got it.
So we'll have to see if this ends up leading to less social spending or a slower pace of public infrastructure development down the road.
So let's move on to how the government's managing its finances.
Okay.
The deficit trends seem to be heading in a positive direction. The fiscal deficit went down in fiscal year 25, and they're projecting another 40 basis point drop in fiscal year 26.
Right.
The revenue deficit is also on a similar path.
Yep.
So is this part of their plan?
Yes. It is. The material specifically says that this downward trend for both the fiscal deficit, which is basically the difference between what the government spends and what it earns, and the revenue deficit, which focuses on the difference between revenue receipts and revenue expenditures, is in line with the fiscal glide path laid out in the 2021-22 budget.
Okay, so they're sticking to their guns.
Exactly. It shows a commitment to a medium-term strategy for managing debt and expenditure, which is usually a good sign for investors and credit rating agencies.
Okay, so that longer-term goal of bringing down the debt to GDP ratio, that's still a major focus, right?
Absolutely. That's still a key focus.
Yeah.
That ratio, which basically tells you how much the government owes compared to the size of the economy, has come down recently, and it's expected to keep going down.
Okay.
It went from 58.1% in fiscal year 24 and they're projecting it to be 56.1% in fiscal year 26.
Okay.
But what's really significant is their goal to get it below 50% by 2031. That's in line with what the 16th Finance Commission recommended.
Okay.
This longer-term target really highlights their focus on making sure the government's finances are sustainable in the long run.
So we've talked about how the budget is becoming a smaller part of the overall economy,
right? But
in absolute terms, it's still growing. It's grown an average of 7.6% over the last 5 years.
Okay.
But that's much slower than nominal GDP, which grew at 12.5%.
Yeah.
The government says this is because they want to improve the quality of spending.
Right.
How do we interpret that?
Well, the fact that the budget is growing more slowly than the economy really shows a conscious effort to be more efficient with public funds.
Right.
The idea is that just having a bigger budget doesn't necessarily lead to better outcomes.
Okay.
So it could involve things like making government programs more efficient, eliminating waste, and focusing investments in areas that will give the most bang for the buck.
So let's get into where the government's actually getting its money. They're projecting net revenue will grow at the same rate as nominal GDP.
Right.
And we're also seeing a significant projected increase in gross tax collections.
Yep.
What are the main things driving this surge in tax revenue?
So the main factors behind that projected increase are stronger anticipated revenues from corporate taxes and improved collections from indirect taxes.
Got it.
It's worth noting, though, that the increase in income tax collections is expected to be a bit smaller because of that tax rebate the government's offering.
Okay, so if we dig a little deeper into those tax collections, it seems like GST, that's the goods and services tax, is really leading the way in terms of indirect tax growth.
Yeah, it's a big contributor.
So what's fueling that strong GST performance?
Well, they're expecting that growth in GST collections to be around 1.6 lakh crore rupees out of the total 1.3 lakh crore rupee increase in indirect taxes.
Okay.
And that's largely due to better compliance among taxpayers and the expectation of higher domestic consumption.
So what about excise collections and non-tax revenue?
Okay, so for excise collections, we're looking at a more modest increase.
Okay.
Growth is expected to come from things like the agriculture infrastructure cess and duties on fuel.
Okay.
Non-tax revenue is a little interesting.
Yeah.
We're seeing a projected return to more normal levels after a really high figure in fiscal year 25.
Okay.
That was largely because of a huge dividend payout from the RBI.
Right, the Reserve Bank of India.
Yeah, India's central bank. Okay. But even though it's not going to be as high as last year, they're still expecting a bigger than usual RBI dividend in fiscal year 26.
Okay, so we've got a pretty good idea now of where the money's coming from.
Yep.
So now let's look at where it's all going.
Okay.
Overall expenditure is set to increase significantly, and that's driven by both regular spending on operations and investment in longer-term assets.
Oh.
What are some of the key areas that are seeing growth in that regular spending, or what they call revenue spending?
So when we break down that increase in revenue spending, a large chunk is going towards interest payments on the government's debt, which is adding 1.4 lakh crore rupees to the tab.
Okay.
Other big areas contributing to this rise include pensions, rural development programs, and agricultural support.
Okay.
These are typically areas that need steady and often increasing funding from the government.
But it seems like the real push is on capital expenditure, also known as Capex.
Right.
And they're planning another significant increase for that.
Yeah, they're definitely emphasizing Capex.
So what's the thinking behind this continued emphasis on investing in infrastructure and assets?
Well, that sustained increase in capital expenditure, with the allocation staying at 3.1% of GDP, is a clear sign that the government wants to keep stimulating investment in the economy.
Okay.
The basic idea is that by investing in things like roads, railways, and ports, the government can create jobs, increase demand for materials, and ultimately boost the country's long-term growth potential.
Okay.
This is what economists call the multiplier effect.
Okay.
That initial investment leads to even more economic activity down the line.
Got it.
The increased focus on public-private partnerships, or PPPs, is also a big part of this strategy.
Yeah.
The government is trying to leverage the efficiency and capital of the private sector.
Okay, so where exactly is this capital expenditure being directed?
Okay, so while important sectors like roads, transport, highways, and railways are keeping their already substantial levels of funding, The material specifically points out a notable increase in Capex for housing.
Okay.
That's interesting because housing has a ripple effect.
Yeah.
It affects a lot of other industries like construction, steel, cement, and glass manufacturing.
Right.
So that investment in housing is going to have a broader positive impact.
Okay, let's talk about how the government plans to finance this deficit.
Okay.
The gap between its income and spending.
Right.
Gross borrowing is expected to be pretty much in line with what the market was expecting. Which is generally seen as a good sign for long-term government bonds.
Right.
What are some of the other key points of their borrowing strategy?
One important thing to note is the expected repayment pressure in fiscal year 26.
Yeah, okay.
That's coming from a significant amount set aside for switching existing bonds for new ones and buying back some outstanding debt.
Okay.
The government is also trying to reduce its reliance on short-term borrowing instruments,
Okay.
which should help stabilize yields on those securities.
Okay.
All in all, these moves point to a proactive approach to managing the government's debt.
Right.
And that could lead to a more stable borrowing environment.
Okay.
We might see a flattening of the yield curve,
Okay.
which is the difference in interest rates between short-term and long-term debt, and a softening of yields in general.
Okay. And we're also seeing a gradual decrease in the government's reliance on its cash reserves.
Yeah, that's right.
So what's the effect of all this on the government's total liabilities
Okay.
and the interest rates it has to pay?
So as the total amount of outstanding government debt or liabilities goes up, so will the cost of servicing that debt,
Right.
meaning higher interest costs.
Got it.
The effective interest rate,
Yeah.
which is the average rate the government pays on its borrowing,
Right.
is also expected to rise.
Okay.
They say that's because the government is issuing more longer duration securities.
Okay.
While this can make the long-term debt situation more stable,
Yeah.
it also means they're locking in potentially higher interest rates for a longer period.
Okay, so that results in a higher average borrowing cost.
Exactly.
So let's shift gears a bit and talk about central public sector enterprises, or CPSEs.
Okay.
Their overall borrowing is projected to be about the same as last year, but there's a noticeable change in which sectors are doing the borrowing.
Right. There's definitely a shift happening.
So what's going on there?
The power sector is seeing a big increase in its share of total CPSE borrowing,
Okay.
going up to 32%.
Wow.
That's being offset by less borrowing from companies in the renewables and petroleum and natural gas sectors.
Okay, so why the big jump in power sector borrowing?
Well, it probably reflects the massive investments needed in the power sector as it adapts to changing energy policies and tries to meet growing demand.
Okay, so now let's look at the government's key priorities.
Yeah, that's always an important part of the budget.
It seems like agriculture, micro, small, and medium enterprises, or MSMEs, and industry are the main areas of focus for the coming fiscal year.
Yep, those are definitely front and center.
Let's start with agriculture. What are some of the specific schemes and funding allocations?
Okay, so for agriculture, there's a clear emphasis on modernization and self-reliance.
Okay.
One of the key initiatives is the Prime Minister Dandanya Krishi Yojana, which aims to transform agricultural practices in 100 districts.
Wow.
By focusing on things like crop diversification, improving storage and irrigation facilities, and making credit more accessible.
Okay.
They've also got dedicated missions with specific funding.
Right.
For example, they have a 1,000 crore rupee mission for achieving self-sufficiency in pulses, and a 500 crore rupee program for boosting the production of vegetables and fruits.
Got it.
Another 500 crore rupees has been allocated to a mission focused on increasing cotton productivity.
Wow.
Particularly of extra long staple cotton.
Okay.
They're also doing some region-specific things, like setting up a Makana board in Bihar with a 100 crore rupee allocation.
Interesting.
They're also making it easier for farmers to get credit by raising the limit on Kisan credit cards.
Okay.
And there are other programs, too, like the National Mission on High-Yielding Seeds and the Rural Prosperity and Resilience Scheme.
So it sounds like they're really trying to cover all the bases in agriculture.
Absolutely. They're definitely making it a priority.
Okay, so moving on to MSMEs, the focus seems to be on helping them grow and encouraging them to adopt more digital technologies.
Yeah, those are the key themes.
So what are the main initiatives there?
So for MSMEs, we're seeing an increase in the thresholds for investment and turnover that determine which businesses qualify as MSMEs. This means more businesses might be eligible for benefits.
Okay.
They're also increasing the credit guarantee cover for micro and small enterprises,
Right.
startups and exporters that are doing well.
Got it.
And something I think is particularly noteworthy is the introduction of MSME credit cards.
Okay.
These cards will have a credit limit of up to 5 lakh rupees for businesses registered on the Udyam portal.
Okay.
It's a way to make it easier for them to get working capital and encourage them to do more business digitally.
Okay. And lastly, industry.
So for industry, the government wants to boost domestic manufacturing. Right.
And make India a major player in the global manufacturing scene.
Yep, that's their big ambition.
What are some of their strategies to make that happen?
Well, it's a multi-pronged approach.
Okay.
One interesting initiative is the National Plan for Toys.
Okay.
They're trying to tap into that huge global toy market.
Interesting.
They're also working on regional industrial development by setting up a big urea plant in Assam and a National Institute of Food Technology in Bihar.
Got it.
The Make in India initiative is getting a boost with a national manufacturing mission.
Right.
And they're also strategically adjusting import duties on key inputs.
Okay.
Things like critical minerals, textile machinery, electronics components, EV batteries, shipbuilding materials, and Ethernet switches.
So they're trying to make it cheaper to manufacture domestically.
Exactly, by making those inputs more affordable.
Exports are a big deal for economic growth.
Yeah, definitely.
What are they doing to boost exports?
They're doing a few things to promote exports.
Okay.
First, they're extending the time period for handicrafts exporters to get their money. Second, they're lowering import duties on some seafood products to make them more competitive.
Okay.
And third, they're raising the limit for exporting railway goods for maintenance, repair, and overhaul.
Right.
They've also set up the National Export Mission with a big budget to make it easier for exporters, especially MSMEs, to get credit.
Okay.
They're developing Bharat TradeNet,
right,
which is a unified digital platform for trade. They're also working on better integrating Indian manufacturing into global value chains and promoting services exports.
Got it.
Including encouraging global capability centers in Tier 2 cities.
Oh, okay. So it sounds like they're really trying to make it easier to do business internationally.
Yeah, they're trying to reduce barriers and streamline things.
Infrastructure development is still a big part of the government's plan.
It's always a key area of focus.
They're really serious about building for the future.
Absolutely. They see it as a crucial investment.
What are some of the big ticket items in terms of infrastructure spending?
Well, first off, they're giving a massive interest-free loan to state governments.
Okay.
1.5 lakh crore rupees to be exact.
Wow.
And that's specifically for capital expenditure and reforms.
Okay.
Each ministry that deals with infrastructure is also developing pipelines of public-private partnership projects to attract private investment.
Okay.
In education, they're expanding IITs to accommodate more students. And they're setting up a new center for excellence in AI for education.
Okay.
They're also continuing to support key national missions.
Right.
Like the National Geospatial Mission. And an enhanced Jal Jeevan mission for clean drinking water.
Okay.
They're also doing sector-specific things like creating a new maritime development fund, revamping the UDAN scheme for regional air connectivity, planning new airports in Bihar, and putting significant money into the Swami H scheme to finish stalled housing projects.
So it's a lot of investment across a lot of different areas.
Yeah, they're really trying to build up the country's infrastructure.
Investing in people is also really important.
Yeah, it's all about creating opportunities.
What are some of the key policies and funding allocations for employment generation and social sector programs?
So for jobs, they've got a focus product scheme for the footwear and leather sector.
Okay.
They're hoping to create a lot of jobs there and boost exports.
Okay.
Supporting the food processing industry in Bihar should also lead to more jobs.
Right.
And for tourism, they're doing things like offering MUDRA loans for homestays and tourism businesses, providing skills training, improving connections to tourist destinations, offering incentives, and making it easier to get e-visas.
Okay.
In the social sector, they're increasing the number of medical school spots. They're also proposing an urban livelihood scheme to help people in cities find work.
Okay.
They're revamping the PM Svanidhi scheme for street vendors, giving them access to bigger loans and digital payment options. And they're putting in new support measures for gig workers, including giving them ID cards, integrating them with the eShram portal, and providing healthcare benefits. They're also doing things like expanding idle tinkering labs to encourage innovation and setting up an urban challenge fund for city-level projects.
So it sounds like they're putting a lot of emphasis on skills development and social safety nets.
Yeah, they're trying to invest in people's futures.
Finally, it looks like there are some changes happening in the area of taxation.
Yeah, they're streamlining and rationalizing some of the provisions.
So what are some of the key adjustments you've noticed?
So they've made a number of changes to the tax deducted at source, or TDS, and the tax collected at source, or TCS provisions. These changes are probably meant to make it easier for people to pay their taxes and reduce the burden on taxpayers. They've raised the threshold for TCS under the liberalized remittance scheme for sending money abroad. They've gotten rid of TCS on money sent abroad for education loans. They've raised the basic income tax exemption limit under the new tax regime. And they've also significantly increased the threshold for TDS on rent payments.
So they're basically trying to simplify things.
Yeah, they're making things a little less complicated for taxpayers.
So let's bring it all together. What kind of impact are all these budget proposals and the assumptions behind them likely to have? Let's start with bank credit growth.
So for bank credit growth, the budget is definitely creating some opportunities for banks to lend more money. We can probably expect to see more demand for credit in several sectors because of the government's focus and support. These sectors include MSMEs, which are getting those enhanced credit guarantee schemes, and the new MSME credit cards, the housing sector, which is being helped by initiatives like the Swami H Fund for stalled projects, clean tech manufacturing, like solar PV and EV production, which are getting policy support. Agriculture, which is benefiting from hierarchies on credit card limits and various schemes. The aviation sector, because of the UDAN scheme. The tourism industry, with the infrastructure development and financial assistance. And even retail loans, which might get a boost from changes in the tax rules.
So those are some sectors to watch.
Yeah, definitely keep an eye on those.
And if we zoom out and look at the bigger macroeconomic picture, what kind of impact can we expect on things like economic growth, employment, and inflation?
So in terms of growth, we can expect a positive impact from all those schemes aimed at boosting agriculture. The strong support for MSMEs and manufacturing, and the push for the services sector, especially tourism. The government's increased spending on infrastructure and social programs will also contribute. For employment, the budget focuses on upskilling initiatives.
Labor-intensive schemes in sectors like textiles and footwear, and a stronger safety net for gig workers. All of those things should help create more jobs. When it comes to inflation. Those small cuts in import duties might have a slight cooling effect. But the real long-term impact on food prices is probably going to come from their efforts to increase domestic production of pulses and vegetables.
What about the government debt market and the exchange rate between the U.S. dollar and the Indian rupee?
So the government's plan to keep borrowing levels stable and reduce its reliance on short-term debt will probably be good for the government bond market. It could lead to a more stable yield curve. And the expected boost to economic growth from the budget could also help the Indian rupee against the U.S. dollar.
So after this really deep dive into the government's financial plan, what are some of the things that really stood out to you? Maybe some things that were a bit surprising. For me, it's their decision to have the budget grow slower than the overall economy, and those really specific targeted things they're doing in sectors like agriculture, where they're even setting up a Makana board in Bihar. You don't see that every day.
That's definitely a niche area of focus. I think for me, what's really striking is that consistent and strong emphasis on capital expenditure. They clearly see it as a major driver of long-term economic development. Also, their really detailed and sector-specific approach to helping agriculture and MSMEs with all those clearly defined schemes and funding really shows what their priorities are, both in the short term and in their long-term vision for the economy.
So for you, our listener, hopefully this deep dive has given you a much clearer and more detailed understanding of what the government's planning to do with its money and what their priorities are. This kind of insight can be really valuable.
As you try to make sense of economic trends and figure out what might happen in the future.
It's all connected.
So before we wrap up, I want to leave you with something to think about.
Okay, shoot.
Given this big push for both long-term fiscal discipline and focused development in specific sectors, what do you think the opportunities and challenges might be for businesses and individuals in the coming years?
That's a great question.
Yeah, it's something to really ponder.
It's something to really think about.
Thanks for joining us today for this deep dive.
Yeah, thanks for listening.
We hope you found it informative.
We hope you got a lot out of it.
And we'll see you next time.
See you later.